Okay, guys, it is 7/9/2025, and we are going to do a quick run through of common forms of dilution. Yesterday, we had some people asking them what dilution is, um, and what certain things were. Um, what I'll oftentimes say is, this company has overhead supply because they have an ATM, and what I mean by that is when you come to my buddy's website at Dilution Tracker, you can come in here and you can say, hey, this company, does anybody have a company that they were playing today that's a small cap company like Evoc? Um, you can come in here and you can say, hey, here's how much cash they have. Here's how they can dilute. Here's a warrant, right? Their exercise price is 12 cents on this warrant. This one's $8. You're trying to see if the company is going to be printing shares out of thin air or if other shareholders are going to be doing the same thing. That's the goal, because it's kind of like when you print money, what happens? Well, your dollar becomes worth less for every dollar that is printed. So your shares become worth less for every share that is printed. That's why in my long-term investments, I'm always highlighting the shrinkage of shares. That's what you want to see. You want to see the shares shrinking, not increasing, because like what Baba did was they bought back 5% of their float, which means your one share of Baba is now worth 5% more than it originally was. Okay, now there's something called the shelf registration, and it's an S3. And if it's a foreign, it's an F3. And what this means is the company can raise money at any time. So there are certain rules like the baby shelf that limit it. But what that looks like is this right here. You see how this says shelf? So what this company did is on August 24, they said, hey, you know what? We want to raise $50 million. So what they did was they sent a thing to the SEC and said, here's our shelf registration. It's telling all the owners of our company that at any point in time that we can raise money. That's a shelf registration. This thing lasts 3 years in that maximum dollar amount, right? So do you see how you had a shelf over here that got replaced, right? So even if you don't use all of the shelf capacity, it'll expire, and you've got to put in a new one. So you can see how these guys are like shelf here, oh another shelf here, oh another shelf here. It's about every 3 years they're putting in a shelf, even if they didn't use it all. And it, yes, I'm recording. And this can be found on Edgar. Do you guys know what Edgar is? Um, I use Dilution Tracker. My buddy runs it, and it's all right here. But he gets all of his information from Edgar, which is the SEC.gov. You can come in here and you can search filings. Whatever name, whatever company, and you can dig through their filings. This is also where you can get like earnings reports and stuff like that. And again, if you watch that, how to find Momo stocks and play them correctly, it's all in there showing you how to do it as well. Okay, any questions on an S3? This is a very basic. Um, you know, every company, every small company has one of these. All right. Why an S3? The company doesn't have to ask the SEC for each raise. So a lot of times what'll happen is if you're putting in like pipes and stuff, which is a private placement, or it would cost a lot of money to continually have to send all this information to the SEC. And so it allows them some flexibility in issuing the equity. But sometimes what you'll see is that the S3 or F3 is not in effect. And what that means is the SEC hasn't approved it. So what happens is the company will send in the S3, and then the SEC will send them back some stuff that says, hey, fix this stuff and you're ready to go. And that's when the effect takes place. That's when it can be used. So it can't be used until that effect is in place. So there's a lot of usages for S3s. You can do, registered direct, equity line of credit, ATMs, and we'll go over some of those. Now, this is always check the baby shelf registration, and that training again is the how to find a Momo stock and trade them correctly. Okay, so I'll sum up a baby shelf. What a baby shelf says is if your company is so small, under 75 mil or something like that, you have to have a baby shelf, which means you can't raise more than 1/3 of your market value. So like if we come down here and we show you, you see where it says shelf, and then we come down here and we're like, hey, does this have a baby shelf restriction? Well, yeah, the answer is yes, it does. So the most they can raise right now is 1.7, even though they have a 50 million total shelf capacity. And the reason that is because their IB6 float value, their market cap basically, is only $5 million. So in order to protect investors, the SEC says you got to get out of this IB6 float. You got to get above 75 mils if you want to just raise as much as you want. So what you'll see a lot of these companies do is they'll push their price up and close out that day. And what that means is, so like you see this highest 60-day close right here. The highest this company has closed in the past 60 days is 382. So the most they can raise is 1.7. Well, what if EBOT can close up here at like $8? Let's say it pushes all the way to 10. Well, what happens? Well, if you can push this thing all the way to 10, then this highest 60-day close goes from 382 to 10. So the way you get your IB6 float value is the highest close times your shares, right? Your float, and that is your IB6. So what would that do? So if we were to take I'm just going to put 1.4 to get rid of all the numbers. It's right there. You see it 1 through 3, 9, 7, 4, 6. And we're to multiply that times 10. Right now your IB6 float value goes from 5 to 14. You divide that by 3, and this is how much you can raise. So $4.5 million. So by pumping their stock, they could tomorrow raise $4.5 million, right? And if you were to, again, divide that by the amount raised, that's 10. So what have they done? They've added 500,000 shares to their float. Well, what does that do? Well, now, instead of multiplying it times 1.4, you got to multiply it times 1.9. You multiply that times 10, right? Well, I think everybody knows what this is going to, oops. Now you can, wait. What did I just do? You should be able to raise another million, even if the price doesn't change. And this is that overhead supply and dilution where they just keep creating shares out of thin air. Does that make sense? All right. So if you want a better explanation, more in-depth explanation of the baby shelf, go to that training. Now, one of the more common ones is an at the market agreement. Do you remember yesterday, guys, when we were talking about the QUBT and QBTS? Which one of them completed their ATM? Do you guys remember? Was it QBTS or QUBT? QUBT, let's see. So these guys did a private placement. QUBT did a private placement. So I think it was QBTS that did the ATM. Yeah, here we go. So do you see how it says used ATM equity line right here? This is telling you that they raised $400 million with an ATM. So let's come up here and say, all right, well, shoot, there's their shelf. So they've got the shelf put in. It was put in April 2024, right? Okay, great. Where, what allowed them to use an ATM? You've got, look at all these ATMs that this company had. Yeah, 400 mil ATM right here. Here it is. Now they can't raise anymore, so they've used this one up. So do you see right here where it's got an ATM? So if we were to see, hey, there was 400 million remaining, right? So do you see how all these ATMs are zero? This company has raised 400, 650, 700, 650, 750, so 800, almost $1 billion this company has raised with an ATM. Now, what does that mean? Okay, well, what that means is literally we're all sitting here and we're like, man, this QBTS chart looks pretty nice, right? I like it. It looks good. Um, let's buy it. It's going to go to the moon. Well, what do you think the company's doing? The company is literally creating something out of thin air. And they're saying, hey, you know what? Let's sell some QBTS shares at $17 to Donnie, who's buying it because he thinks it's going to go to the moon. But in reality, we're just creating shares out of thin air and selling it to him and pocketing the money. So they got a free $17 because they sold me a share. They didn't pay anything. And so this keeps a stock price down dramatically, right? Imagine if they didn't issue $400 million worth of shares, how much higher QBTS would be. But these companies that don't make money, there's only one way to raise money, and that's through the investors. They can do it through pipes, right? They can do it through an S3, they can do it through ATMs, but they make the investors pay for basically, how would you say it? Whether you want to or not, you are going to be funding their, quote unquote, research and development of whatever they're doing, be it quantum computers, be it biotech, whatever it is, you're funding their R&D because they're not making any money, and the only way that they can raise is through dilution. All right, so they're known as an ATM that's financing through the shelf. It creates new shares. Specific amount can be raised. Again, found on Edgar. That's exactly right. They absorb the demand, and it just goes down. And this is this is what it'll look like. Here, let me see if I can make it a little bit more visible. So when you go in and you're like, hey, what does an ATM look like? You'll begin to notice the same companies run the same programs over and over, like HC Wainwright. They're known for their pump and dumps, right? And it says sales of our shares of common stock will be made in sales deemed to be an at the market offering, meaning they can just sell at the market anytime they want. So they have a free button that they hit sell and they just get free money because they're creating shares out of thin air. Okay, now oh, here's another one. Who wants free money? Maybe I should just keep it keep it large here. So what happens is on they'll say something like on May 4th, 2020, the company initiated this program, the ATM program. It'll be distributed at market prices prevailing at the time of sale. Aggregate amount of 40 million. through this time period, right, we've sold X amount. And so as you get reports from these companies, they're going to tell you how much they've used. And that's where the dilution tracker comes from, right? He can pull it straight from there. Now, how do you tell if a company's using the ATM? You can usually see pretty big people on tape or via volume profile. And one of the ways I made my first million trading, one of the ways I made my first million trading was shorting companies like this. It's so easy to find these companies that are diluting and short them. It is a great edge if you have discipline, because if you do not have discipline, all it takes is one company of BMNR or wherever, right? If you don't stop out when you're supposed to stop out and something like this happens, you're going to get killed. You'll blow up your entire account. So if you have discipline, this is a great edge. Great edge. Now, volume is highly important. How many how many shares can a company sell through an ATM? So let's just pretend that we have a $400 million ATM, and the price of the stock is 400. Let's say $10. Well, how many shares can they create out of thin air? That's 40 million. So if they trade 1 million shares every day, it's going to take them a while to get through that 40 mil, and it's going to have a huge impact. It's going to keep the stock down. But what if it trades 150 million every single day, or 300 million every single day? When you get these, this is part of the programs that they run. They'll literally run the algos to create fake volume so they can get retail to come in. And what it does is it allows them to dump their ATMs without moving the price a whole lot, but by creating fake volume. And so if a company can only raise, let's say they can only raise 1 million shares, and they trade 100 million every single day, the ATM is not going to have that much of an impact on them. Does that make sense? It's like 1% of the shares traded. So the simple game that we play here, if you have $40 per share and you have a 40 mil ATM, the average volume 55 million, how much impact? Well, $2 per share, how many shares would it create, right? And that's what we just did. So you just divide that 40 mil by the $2. And if the average volume is 2 mil, well, how much more of an impact? Now, when do they use an ATM? They use it anytime that they need cash, right? If you can't get a bigwig to come in and partake in an S3 offering, or if you can't get an existing shareholder to put in a private placement, then you're going to use an ATM, right? Then you're going to try to get it from the shareholders. And again, you want to use burn rate for that. So here, if we, oh shoot, thank you. Sorry about that. Here. Finnegan screaming at me. So quick review, can see the dilution on the tape, creates a good short opportunity. Keep volume in mind. If you have a lot of volume and they can only issue a few million shares, it's not going to have that big of an impact. But if you have low volume and high amount of issued shares, it'll have a huge impact. And you want to use their burn rate. So let me show you on here. So if we look at QBTS, do you see how it says the company has 119 months of cash left with a cash burn rate of 20 million a quarter and an estimated cash? Do they need to raise? Well, no, they don't. They just did it. But if we look at EVOC, let's see if they need to raise. Not really. They have 34 months of cash left. They have a small burn rate, and so sometimes, what are some other low flow crap companies like SBET? So they have cash as well. They have a lower burn rate, but sometimes it'll be like, hey, they've got negative 2 months of cash, or they've got 4 months of cash, and when you see that, you know that they're going to start diluting. Like that. That's why they're pushing the stock up. It's going to be diluted, and so what I would look for all the time as a short seller was I want to look for a company that needs cash badly. And you could actually reverse engineer these and front run the pump. If they need cash badly, what are they going to do? They're going to pump their stock up. They're going to put some crap fake PR out like, hey, we got a, patent for this, whatever. And then the retail's going to push it through the roof. And then that's when they're going to start diluting. And I want to be a part of that because I want to short it all the way down, right? So just because an ATM does exist doesn't mean they're going to use it. So if you're just shorting based off of that, a lot of times you're going to get squeezed. All right, so warrants. Warrants are similar to an option. The holder has the right to buy XYZ stock at a specific price. Proceeds go to that XYZ stock from the exercise price, and then the profits, stock price minus the exercise price, goes to the guy that has it. This can be found in offerings as well. Same idea, pay attention to volume. So what this means is, if we were to go back and look, see if I can find warrants. So yeah, so this one's a pre-funded warrant. So what happened was this company has pre-funded warrants, right? SBET has pre-funded warrants, and they've got 1.5 million of them. Well, what's the cost? So somebody that bought into their company that did a pipe, they were given $2.94 costs, right? So what is SBET currently at? Well, if we were to look up SBET, it's at $16.53. So what can the owner of this warrant do? So they would say, hey, you know what? Let's exercise this warrant, and we're going to sell at the market, and we'll profit the difference. So that 294 goes to the company. The company's happy. They make money. You subtract that 294, let's just say it's 1650, and you're going to get $13. So the guy that bought the warrant is happy. He made $13.50. So everybody's happy except who? Who's the only people getting screwed here? Well, it's the retail trader who owns the stock at 16. So they can dilute this down and just create shares out of thin air because they have an option for the right to do that, right? Now, this actually isn't a whole lot. It's only 1.5 million shares. This is another 50,000. That's not a lot. And if you come down here and you look at the float, man, look at that ATM. Look at this thing. See, this is what I'm talking about. Like this company, it can just press sell at any given time. They have an unlimited shelf. Like this is just a junk company from the word go. If you're buying SBET, you may be a Momo trader, but if you're buying it for an investment, you're not the smartest, brightest bulb in the box. Man, what a junk company. But anyway, sorry, got a little distracted on how much dilution there is on that stock. Back to full screen. So there is warrants that are not pre-funded. So you can have pre-funded or not pre-funded warrants. And if it's pre-funded, that just means they paid for them. And what that means is there's a much higher incentive for them to pump the stock, right? Like if you've already paid that $2.94, you don't want to waste that $2.94. The stock needs to be pumped so that you can exercise your warrants. So if it's pre-funded, they go ahead and give them the money. If it's not pre-funded, they give it to them as they exercise it. You'll often see like there's certain types of ownership. If you get above 10% or 20%, you have different rules that you have to abide by. So a lot of times, what will happen is people will take warrants and keep their um, ownership count down so that they don't have to follow those same rules. And you can copy that. And then you have variable rate convertibles. These are extremely toxic. All that happens here is the holder converts debt into shares at a variable price. The profit is the stock price minus the conversion price. So what'll happen is it'll say something like, did they have any? Yeah, so like, so they've already done their conversions. They've already done it, and then the reason the price is so high is because the stock's done reverse splits and stuff. But what it'll say, let's see if I can find one that no, they don't have one. Yeah, they've already used theirs as well. So anyway, we'll just use this as an example. What'll happen is they'll say, hey, you know what? We have a convertible note that we can convert our debt into shares, and let's say we owe $500 million or whatever, $100 million. Well, it'll have a conversion price, 50 cents or whatever that conversion price is that everybody agrees to. But ultimately, this doesn't really mean anything if, and most of them do, they have a clause. And this clause will say, hey, you can convert, and all you got to do is take 90% of the previous 3 days of VWAP. So if, let's say, $5 was your convert price, but your 90% of the previous days of VWAP is $2, well, automatically, because you are taking 90% of VWAP from those days, you're going to be above it. And so that $2 can be used, and you can sell it for whatever it's at the time, 250 or 3, and you can just continually do this over and over and over until your 500 million gets paid. And what happens is literally as you do it, the more shares you have, the lower the price becomes, which means what? That means you can't issue as many shares at that same price, and you're just bringing the price down, 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 down. So if you did it at $10, right, and the price was at 11, well, you're putting pressure on it. Now you've put so much pressure on it that it's dropped the price to 9. You do it again, you drop it to 8. You do it again, and it's just you can't issue the same amount that you did at 10, and it's just like a death wheel. And it's just these when this stuff starts happening, it's like I won't trade these companies. Like these companies that have these converts like this, yeah, I'll short those all day, every day, because it's a death wheel. It's just going to bring the stock all the way down. Does that make sense? Does everybody this make sense, guys? I know I'm running through it kind of quick. So variable rate contracts. XYC company issued 6 million convertible notes. Rate equals lower a fixed price, $2 or 85% of VWAP previous 10 days. Minimum price 30 cents, right? Toxic because it continued downward pressure as a holder converts, price drops. As price drops, more shares have to be converted to equal that amount that they did just the time before. Example, 6 mil at $2 equals 5.8. 6 mil at 36 equals 20 mil, right? So you just start creating this funnel of dilution and increased share count. And then once they run through that, then the company's going to oftentimes say, let's do a reverse split now so that we can lower our share count and continue the process over. And they'll lower their share count from the 100 million and they'll do a 10-1 or whatever. And then they'll lower it to like 10 million or 1 million or whatever. And then it's easier to manipulate. And then they'll run the same thing again, the same playbook. Um, Again, can be found in Edgar as well. Oh my gosh. I should never use full screen, right? So here, let's run through it again. At least the verbiage is right. I don't even know where I went off. All right, so variable rate converts. Any questions on variable rates? Like all you're doing is you're issuing it at a certain fixed price that is lower than the current price because it's 85% or 90%. Um, the difference in 6 million at $2 versus 6 million at 30 cents. It's quite a bit of difference. You can issue, you know, 4 times more basically. So if you see these, run for the hills. Unless you're short. Now, private placements, these actually can be okay. Now, let me explain why. So, when you get a private placement, you don't even have to have an S3 to do a private placement. You can go ahead and raise, because what you're doing is you're basically getting somebody that believes in your company that already owns part of your company to do a pipe. So, oops. Okay, remind me to switch back, guys. I'm switching to the small screen. So, like, if we go to QUBT, let me show you what they did. So, do you see this private placement here? They raised $200 million from Titan Partners. So, you see how Titan Partners is already, they're already a part of this company. Like, they love them and they want to be a part of their company. So, they're like, hey, we'll give you some more money. Well, what happens is, this happened on 6/23, and they gave them $14.25. So let's look at QUBT. And what was the date? It was 6/23. Right here. So I don't know if you guys remember when this news hit and we dropped like this. This is when I'll come in and I'll say, hey guys, this is a strong offering play, right? What that means is if they would have bought it at like $9 or $8 or $5, that's not a strong offering. We're relatively close to the price of where we're trading, so they're paying up for this purchase, right? So the company just shored up its balance sheet with $200 million. You've got this company that believes in them, that most likely is smarter than us, and they're putting in $200 million. So if you can get close to where they're getting, that's great. Well, what do you think these guys would do if this thing dropped to 13? You know what I mean? Like if they really believe in the company, they're like, well, shoot, now we can get it at a discount. So you probably have built-in buyers around this level. And that's what creates a strong offering. And a lot of times this is what happens during strong offerings, right? You get this quick pullback close to where it was, and then you just rally because people understand there's built-in buyers down here. Does that make sense? And so private placements don't have to equal bad. Does that make sense? It can be a good thing. Now it can also be a bad thing if you're trading at $20 and there's a private placement at $5. Obviously, the company desperately needed the money and thought that they were way overvalued at $20. One of the other things that you will see is a resale registration where people that own part of the business will be selling some of their shares. So that's not diluting your company, but it's moving shares from like institutionally held to the float. So like if you have a 4 million float, but there's 10 million shares, right? And so 6 million are held by institutions. Well, if Titan Partners says, hey, we want to sell some of this, and they can do a resale registration to sell. And you'll want to be aware of where that cost basis was, because if it's at 14.25, right? If they're going to be selling what they bought at $14.25, obviously they want it above $14.25. Okay. Besides the forgetting to switch back, I think I did pretty good. Any questions on this? And that's what these these rules right here is what allows them to sell under an exemption to the registration, right? There's just a bunch of different rules. All right, let me close this out and I'll catch up on chat. D-Man, incredible that you found Esprit. Purchase. Okay, question. Does exercising the warrant and selling the stock cause a price decline? The answer to that is anytime that you have selling, that increases the distribution, which means it has a downward effect on the stock. So, for example, if 100 million people want to sell a Tesla at $20,000, but only 10 million want to buy one, what has to happen? Those 100 million people that want to sell have to lower their price to beat the other people that want to sell. And that's the supply and demand side of it, right? Anytime you have excess demand, it goes upwards. Anytime you have excess supply, it goes downward. And so this always increases the supply of distribution. Does that make sense? Does that answer your question? Yeah, anything that tell you to join the WhatsApp is a scam, right? All right, I'm going to stop this recording.